I'm Selena Wang in San Francisco, and for Emily Chang, this is Bloomberg Technology. Coming up in the next hour, Tesla has its foot on the gas when it comes to earnings, reporting a week earlier than expected. Has its production hell come to an end, and is the company even close to breaking even? Plus, Uber loses another. A key deal-making executive resigns. Now, does this impact their road to the IPO? We discuss. And Sun steps away, why the head of Softbank was a no-show in the desert, and what this means for the future of the Vision Fund's ties to Saudi Arabia. But first to our top story, Tesla is pushing up its earnings by a week. The announcement was made late on Monday and comes as Tesla is expected to deliver a record quarter and even come close to profitability. Now that's according to none other than CEO Elon Musk. Morgan Stanley says the move is to speed up its earnings, and it's more likely a positive sign than an adverse one. And following this announcement, Citron researchers Andrew Leff performed a surprise U-turn, saying he's now long on the company. Shares rose up in Tuesday trading. Now, Leff has been a vocal long-term shorter of Tesla, but now says, quote, like a magic trick, while everyone is focused on Elon Musk smoking weed, he is quietly smoking the whole automotive industry. Now, we'll hear from Andrew Leff himself later in this hour, but let's first turn to Pierre Ferragut of New Street Research and Bloomberg Businessweek's Max Chafkin for our full analysis. Now, Max, what's your take on why they decided to push up earnings so early? I mean, is this a positive story that they want to tell fast?
The conventional wisdom, if you look at what's happened in the stock market and also this Morgan Stanley note, is that they pushed it up because they have good news to announce. And the support for that is sort of statements from Elon Musk that came at the end of the quarter, and this sort of general intuition that why would you want to push up bad news? The only caution I'll say is that it's a little bit dangerous to impute sort of normal business logic to this company or to Elon Musk. He's somebody who has a track record of doing things his own way, and it would not shock me if these guesses turned out to be wrong.
Pierre, you had an interesting research report when you wrote that you expect Tesla to have a major beat in free cash flow. Now, why are you predicting that, and why is the street not catching on to that?
Thanks. Yes, so we already know a lot about Q3 for Tesla. The company has reported how many cars they've produced, how many cars they've been able to deliver to clients, and we know that clients pay cash very rapidly the cars they deliver. So that gives us a lot of information, and I think the one element that the street is probably still missing is the fact that when Tesla sells a new Model 3, they've bought a lot of raw materials that go into the car, but they pay these raw materials only 2 to 3 months later, whereas they sell the car immediately. And when they sell the car immediately, they cash in the full price of the car. So each of these Model 3 that Tesla is selling is actually bringing in the bank the profits booked on the car, of course. And in addition to that, it's bringing in working capital to the tune of $20,000 per car. So $20,000 per car times like nearly 40,000 additional cars the company is producing and delivering this quarter, that's actually $800 million of revenues that the street has largely overlooked.
Max, Citron Research's Andrew Leff took a huge surprise reversal, saying that he's now long on Tesla, and he's been a very vocal short. He said there is no Tesla killer, and that is light years ahead of the competition in his report. What's your take on that?
Yeah, I mean, I think, first of all, a very clever turn of phrase on smoking the auto industry. And I think, the sort of quiet story of this company for the past few months is that while, the CEO was behaving very colorfully and getting in the crosshairs of the SEC, this company was quietly producing tons of cars, doing something, pretty amazing when you just look at the history of the auto industry. The speed of this ramp up in terms of production is pretty unprecedented. And right now, like the Model 3 is outselling most cars in its class. So quietly, Tesla has become this force. Now the big question is, can they make it profitably, and if so, how profitably?
Right, and on that note, Pierre, let's talk about this $45,000 Tesla Model 3. Can Tesla be profitable at that price point, and what are the margins you're expecting?
Yeah, so $45,000 is actually the average selling price I expect for the Model 3 in the long run. So in the long run, like the simplest car with no options will sell for $35,000, and we know like the highest price models go in excess of $70,000. And I think if you compare to what has happened in this industry, like equivalent models at BMW, at Mercedes, I think $45,000 is a good average. So I would expect that car, the build Tesla offered over the weekend at $45,000 to be at that kind of average gross margin the company expects in the long run, which is 25%. Now, of course, this 25% gross margin is still something that you will get once production hell is over, once overcost related to yield, related to quality issues will be off the table. So it's more difficult to know exactly what the profitability of this car will be in the very near term, but fairly rapidly it should head toward 25%, which is the average for the company.
And Pierre, how are you factoring in this recent settlement with the SEC? Is this going to be a significant headwind to the company? There's going to be more oversight on Elon?
That's a very good question, and if you want a honest answer, I see that as a great positive. Elon is an exceptional individual, an exceptional engineer, and an exceptional executive as well, but his personality has its drawbacks, that's the least we can say. And a bit of oversight can only do good. I think controlling his communication on social media will benefit everybody, himself, the company, and myself. It will make my life easier. And more broadly, I believe a lot, in corporate governance, and having a chairman who is not the CEO is something I see as a positive, whatever the company.
And Max, what's the latest that we know about potential candidates for the chairman, independent board directors?
Yeah, I mean, the assumption is that it's going to be somebody from who's currently on the board of directors. I think the name people have thrown around is James Murdoch. The main thing I think Tesla and Elon Musk are probably looking for is somebody who's not, literally his brother or his best friend, who are both, on the board, but somebody who he knows, he trusts, but who, can still bring some measure of independence.
All right. Well, Pierre Farragut of New Street Research and Bloomberg's Business Week, Max Chafkin, thanks both for joining us. U.S. stocks tumbled Tuesday, driven lower by weakness in tech. In particular, chip makers are trading at their lowest in a year. Now, that's ahead of key tech earnings later this week, including Amazon, Twitter, and Google's parent company, Alphabet. Joining us to discuss is Bloomberg Markets Live senior editor Michael Regan. Michael, it seems like investor nerves are at an all-time high. We've got trade tension issues, Brexit, concerns over interest rates. Can big tech earnings change the winds?
Well, I think they certainly can. I mean, tech obviously has come very much off its highs for the year. If you look at the New York FANG Plus index, the index that the so-called FANG futures are based on, it's down about 18% from its high in June, almost entering a bear market officially at it with a 20% drop. Now, obviously, a lot of the big tech names are still doing good for the year. Amazon obviously still has a very strong year-to-date gain. Google's Alphabet is still hanging in there year-to-date. But that drop since June has really frayed sentiment to some degree. So looking ahead to Thursday with Amazon and Alphabet both reporting after the bell, it's definitely going to be a marquee event for Wall Street, especially because both of those stocks are very famous for the size of the moves they typically make after reporting earnings. Amazon has gained or lost on average more than 7% after its earnings, mainly because it tends to surprise Wall Street to a great degree. The average surprise, either miss or beat in EPS for Amazon, is over 50%. And Alphabet, too, moves about 6% on average after earnings. Options are implying similar moves for both stocks. So they're going into this report with some very weak recent momentum, which suggests any sort of surprise on the upside could be a positive catalyst, not just for these two stocks, but for the market in general.
And digging into Amazon, there is some concern that they're going to face significantly more margin pressure. I mean, how much of a concern is that from the investor perspective?
I think it's a big concern, not just for Amazon, market-wide, it's a very big concern. Looking at Caterpillar, a very big slump for that stock today, after warning about rising costs and margin pressure from a variety of things, including trade tariffs and that sort of thing. Now, tariffs are unlikely to be a major concern for, say, Amazon and Alphabet, but they are definitely an unknown for Amazon specifically. And wage pressure, of course, is going to be a big theme for Amazon after they announced the increase in their minimum wage. Part of the story with the entire market and tech in particular is this notion of this very robust earnings growth this year kind of fading a little bit next year. And Amazon's kind of a poster child for that. Expected to increase EPS by about 480% this year. That goes down to 36% next year. For Alphabet, EPS growth is expected to drop from 52% this year to about 11% next year. So I think investors will really be looking for any sign that perhaps those growth outlooks have come down a little too much.
All right, Bloomberg's Michael Regan, thank you for joining us. Coming up, Uber wants to go public, but it's missing a key deal maker. So just who fills those shoes? Coming next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Uber is said to be heading towards an IPO next year, but it looks like it'll have to do so without a key executive. Head of corporate development Cameron Poster has resigned. Now, this comes after allegations of sexual misconduct, which the Wall Street Journal says he was disciplined for and expressed regret. Pocher played a key role in negotiating Uber's $9.3 billion deal with Softbank this January. So how does Uber move forward? To answer that, I'd like to welcome in Bloomberg Tech's Eric Newcomer, who covers Uber. Now, Eric, Cameron has been called a trusted advisor to the CEO. He negotiated a lot of big deals. What exactly does this mean ahead of the IPO?
Yeah, he was a key holdover from sort of the reign of Travis Kalanick and a confidant of Emil Michael, then the top deal maker, and sort of come in and help Dara. So it's a big void for the company. Nelson Chai, the company's CFO who'd worked at Merrill Lynch, is sort of filling that role. Cameron was leading corporate development, and some of the business development tasks have already been moved over to another executive, Andrew McDonald.
And this isn't the first departure in the finance group. You've reported on a lot of executive turnover there. I mean, what's happening exactly?
Well, I think a lot of them knew that Uber was going to bring in this outside CFO. So, the acting head, one left for one startup, one left for another, DoorDash. So there was just all this sort of exodus ahead of sort of the new guy coming in, and then that's left some vacancies.
Right, and he left because of sexual misconduct allegations. I mean, when you talk to sources at the company, where is employee morale right now?
Yeah, so we know, the Wall Street Journal reported on those allegations. Cameron apologized and resigned. He'd been there 4.5 years. I think the company is still sort of soul searching after all the problems of 2017. There are questions about remarks made by the chief operating officer, Barney Harford, that the company has been looking into. So I think there's just sort of a lot of soul searching going on right now and sort of investigations.
Right, and switching gears a little bit, Uber is increasing the cost of a ride in London by 20 cents per mile, and they're creating this $260 million fund to help drivers switch to electric vehicles. I mean, how exactly would this work from a driver's perspective in London? Yeah,
I mean, Uber says the money will sort of go to drivers to help them sort of buy those vehicles. I think it's a smart positioning for Uber because these ride-sharing companies don't want to be seen as forces for congestion that are clogging the roads and hurting the environment. And by even for Uber, what's a small amount of money is sort of good optics and a good way to sort of help transition the fleet to an electric one, which would be a much better look for the company.
Right. I mean, how much of this is just good public relations for Uber? They're battling this court appealing, just days after
about
this.
sort of the status of their employees all over the world. So, I mean, for Uber, everything's a sort of, there's a calculus of the PR message, and I do think electric vehicles is an endpoint that over, a longer span of time, ride-sharing companies are going to want to end up to. So investing some small amount of money to move them there, I think, is a smart decision. We'll have to see how it actually plays out in the real world.
Right. Does this also help Uber competitively in terms of luring more drivers? This is another new incentive, of course.
Right. I mean, if you're a driver and there's some pool of free money, even if it's small, that gets me a sort of more fuel-efficient vehicle, obviously there's an economic calculus that you're making about whether you can make more money working for Uber or a competitor.
And how effective do you think this new fund is actually going to be? It's a great idea in
practice.
I
think it's really sort of soon, and we'll have to see how it plays out and how much money Uber puts behind it. And obviously just the availability and affordability of electric vehicles will have as much to do with the amount of money Uber puts behind it.
Right. They have a goal of having only electric vehicles on London roads by 2025. I mean, is that realistic?
Again, it has as much to do with sort of electric car manufacturers as it does to Uber. There's a limit to how much money Uber can put behind it if the cars aren't there.
All right, Bloomberg's Eric Newcomer will be watching this closely. Thank you for joining. Coming up, legislation often adapts to address new technology, but how does the government itself integrate itself into daily services? How Code for America aims to bring bureaucratic processes to the digital age. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg. How does the government use technology to run the country? Government services are often slow and bureaucratic, making them less accessible to millions of people. Nonpartisan group Code for America wants to help. Code for America uses the principles and practices of the digital age to improve how government can better serve the American public. Emily Chang sat down with Code for America's founder and executive director Jennifer Palka at the Wire 25 conference to discuss. Take a listen.
We continue to work with states and counties and cities, and now we're doing things like we've been showing how much easier it is to, for instance, apply for food stamps. Was an hour-long process, always got messed up. Now it's really simple and across almost the entire state of California, which is really wonderful. But we're taking it a step further. If you're going to apply for food stamps, you might also need Medicaid. Why are you filling out 2 forms? It's the same information. So we're showing in 5 different states around the country how you can integrate that and make it so much easier by doing more than one service at a time.
Now, you spend some time in D.C., but really you're going to like Baton Rouge, Louisiana. Give us an example of some of the work you're doing in particular states.
Yeah, so in Baton Rouge, we're working with the state of Louisiana. Medicaid enrollment is a real challenge there, and we're helping them take these user-centered, iterative, and data-driven practices into the application of their technology to administer Medicaid.
Amazon CEO Jeff Bezos made the point at the Wired 25 summit that government programs are actually, many of them, quite well funded, in the billions of dollars, and yet to many citizens they seem inefficient and ineffective.
Yeah.
Is the problem with resources? Is the problem with how the resources are deployed? Is there a problem with the kinds of people who are employed delivering these resources and delivering these programs?
The problem is that we have neglected the machinery of government, and that's been a choice that all of us have made. We wanted government to be very risk averse, we want it to be very accountable, and we haven't taken all of that talent and these new approaches that you see in great companies and applied them in government. And I don't really think that's the fault of the public servants. I think that's the fault of the American people. So if we help create this situation, we can absolutely help change it. And that's really what we're trying to have everybody understand. neglecting the machinery of government is a choice. Let's all make a different choice. Let's put the best talent and these approaches that really work, that start with users and iterate, let's put them in government, and then we'll have a government we're really excited about, and that's so important.
You were in the room when President Trump had that first meeting with tech leaders, and at the time there was a lot of concern about how the White House would bridge the gap between Washington and Silicon Valley and could perhaps hold back the march of technology. Have you seen that?
What I have seen is that groups like the United States Digital Service, still operating in the White House, still run by some of the best people that Silicon Valley claims that any private sector or public sector sort of rock star would claim. They're still doing great work, and that's just so important for everyone to understand.
So you're not concerned about the progress of technology under the Trump administration?
What I'm excited about is that you have great people there doing work that we all support, and I'm very glad that they're still there and still making government work better in ways that really do match my values.
Google recently dropped a big contract with the Department of Defense, and employees at Microsoft and Amazon have protested their companies bid for big government contracts. I mean, how should tech companies handle these situations? Should they be working with the U.S. government?
It depends on the situation, obviously. I think it's great that Silicon Valley companies and other companies are thinking more and more about their relationship with government and where they can use their power to express their values and the values of their employees. I want them to do that. I also want them to spend some time in government so that when they make these decisions, they can really see it through the eyes of the people who are working in public service. So many of them, the vast majority of them, really are doing public service because they want to help the public, and I want to support them too. And I really want public servants to understand Silicon Valley. I also really want Silicon Valley to understand government and public service.
Do you think there's too much moral exceptionalism and arrogance among people in Silicon Valley that they think they can do it better than everybody else?
I think that Silicon Valley has still a long path to go down of really understanding how government works and becoming part of it. We just did this, panel here at Wired, and Anand finished with the line, "Government is us." Let's remember that. Let's remember that and really get involved.
That was Code for America's founder and executive director, Jennifer Palka. Coming up, Sun says no, why the Softbank CEO is dropping out of a Saudi conference and what this means for the future of their vision funds. That's next. Plus, Twitter has been cracking down on millions of fake accounts, but bots are still linked to pro-government regimes. Can its open platform withstand the manipulation? This is Bloomberg. This is Bloomberg Technology. I'm Selena Wang in San Francisco, in for Emily Chang. Now, after plenty of will he stay or will he go speculation, SoftBank CEO Masayoshi Son has pulled out of an investment conference in Saudi Arabia. The move comes after Saudi officials admitted to the killing of journalist Jamal Khashoggi and what they called a fistfight inside their Istanbul consulate. This makes Sun the latest in a string of high-profile exits from the Saudi event that includes SoftBank COO Marcello Claure. And remember that Saudi Arabia remains one of the SoftBank Vision Fund's biggest backers. They've already committed $45 billion to the first fund and promised another $45 billion for future funds. To discuss in Half Moon Bay, California, we've got Ray Wang, founder and principal analyst of Constellation Research, and in the studio, Bloomberg Tech Sarah McBride, who covers venture capital and startups. Sarah, we've reported that Masayoshi Son was actually in Riyadh and met with the Crown Prince, but he has stayed away from the actual conference. Right. I mean, what is the significance of this? We know he has a close relationship with the Crown Prince.
Right. So he essentially dropped out in a much more gentle way compared to some of the other business leaders who left. It was sort of a compromise. He went to Riyadh, essentially met with the Crown Prince and other Saudi officials on the sidelines of the conference, but didn't go to the conference itself. However, a lot of SoftBank execs remain at the conference.
Now, Ray, we've seen many top executives opt to stay away from the conference, but have continued business relationships with Saudi Arabia. Do you think that the turn of events could fundamentally change the relationship between foreign businesses and Saudi Arabia, or do you think it will eventually be business as usual?
I think the money is too hard for people to turn away. And so I think people were hoping that this would blow over. And when it didn't blow over and the facts got worse, people got scared. A lot of the startups, as you know, have very progressive viewpoints. And to have this type of money taint or impact their perspective of what's going on is a challenge. But the double-edged sword is for Saudi Arabia to move out and to progress, they have to make these types of investments. So I think it's going to be a lot of difficult decisions for a lot of startup entrepreneurs and for a lot of the investors.
And Sarah, given the intense pressure and scrutiny, what are the chances that SoftBank will actually go elsewhere hunting for the $45 billion for the next fund?
Well, I think it's pretty hard to say at this point, and it'll be interesting to see if an argument gets made. Much has happened with China, that SoftBank can perhaps influence Saudi Arabia somehow from within and help it become more progressive in certain ways. So I think a lot of people will be starting to try to tell a different story about Saudi Arabia.
And Ray, it's worth mentioning that Saudi Arabia has a very long track record of investing in the technology industry, and that it also has a very long track record of human rights violations. So is a result of this going to cause entrepreneurs and startups to look more critically at where their money is coming from, especially if it's Saudi Arabia?
I think we're going to see a transformation in Saudi Arabia long term. I think this is a lesson learned from MBS as well as for the Saudi government to realize that their actions have a huge impact around the world. And investors are going to take note to see what type of ethical reforms may take place in terms of how not only how Saudi's actions affect their investment thesis, but also how those actions affect investors' perceptions about doing business in Saudi Arabia.
And Sarah, you've been speaking with venture capitalists and startups. What's the sentiment you're getting from them? Is there any instance of a startup turning away money from SoftBank?
I've heard there's actually a startup that's currently weighing a term sheet from SoftBank, and because of these allegations, a term sheet that they probably would have accepted without too much thought, they're really wondering whether to take the money or not. And I think more broadly, startups are going to start asking more questions about the investors that their own venture capital investors have, and that really hasn't been the case previously.
And Ray, we're seeing tech employees have a lot more influence over their employers. Just one example is the Google protests that caused Google to not renew a defense contract. So do you think that we might see some sort of revolt within companies that choose to take money from certain sources that are deemed unethical?
We definitely see that. We're here in Half Moon Bay at a conference, and literally the top conversation was, do we accept money from countries that might not have the same values or same views on human rights or ethics? And that was a big discussion today, really about what happens. And I think you'll see that. And I think, there are a couple companies actually in play with SoftBank as well, as Sarah was saying. They are seriously evaluating the term sheets. They're wondering if they can take that money. They're wondering if they can put some conditions on behavior as to what to do with that money. So I think we're going to see that. And the other piece we may see, too, is with SoftBank, whether they use the last piece of that vision fund. There's about 10 to 15 billion in that they might just actually say, hey, that's just an excess expense and not recognize that revenue for that fund. So we may see some actions like that to soften the blow.
And Sarah, you've reported on other venture funds like Sequoia raising billions and billions to compete with SoftBank. So could this potentially benefit companies, funds like Sequoia, in terms of competing with SoftBank for later stage deals?
Absolutely. It's just one more piece of ammunition those other firms will have now. Then they often talk about their investors and say, hey, we're helping hospitals, we're helping college endowments, and they might not want to say who you're helping if you take money from SoftBank, but that understanding will implicitly be there, that maybe you're helping people you don't want to help.
And Ray, how do you think this could impact the overall tech ecosystem? Money from sources like Saudi Arabia have come flooding into Silicon Valley. It's arguably raised valuations. Could this, cause valuations to actually come down and make it a chiller ecosystem for funding?
I think it could change the ecosystem play, and I think it's important to see that impact, because the $100 billion vision fund and the 5 other ones that Masayoshi-san was thinking about creating, those are all, at risk at the moment as people think about whether they will accept that money, as well as the perception of that fund. So I think it's going to be up to MBS and Saudi Arabia to actually put out a statement that express what they're going to do going forward, so that there's at least confidence I'm sure those were some of those discussions that happened on the side in those private meetings about what can we do to actually either change behaviors or look and relook at the investment profile for these funds.
All right. Well, Ray Wang of Constellation Research and Bloomberg's Sarah McBride, thank you both for joining. Coming up, Twitter bots have been linked to a series of pro-government messaging in places like Iran and Saudi Arabia. Can the social media company successfully fight off future attacks? This is Bloomberg. Twitter has become entangled in the tensions over Jamal Khashoggi scandal. Last Thursday, the social media company suspended a network of account bots for pushing pro-Saudi talking points. Several accounts tweeted and retweeted messages pledging loyalty to the kingdom's Prince Mohammed bin Salman following the journalist's disappearance. The suspension is the latest in Twitter's crackdown on bots following Russia's interference with the U.S. elections via the social network. And the company has also disclosed accounts linked to pro-Iranian government operatives. Here to discuss is Director of the Digital Intelligence Lab Institute of the Future, Dr. Samuel Woolley. Samuel, we are seeing these manipulation happen on social media across countries more and more ever since the 2016 elections. I mean, how are the tactics of these bots evolving?
So whereas before we saw a lot of very basic automated accounts on social media being used to amplify likes or retweets, now we're actually seeing bots being used to amplify attacks, targeting, harassment of journalists, women. And this isn't just happening in the United States, this is happening all around the world and you know, arguably has been happening for quite some time.
And now there were reports that Jamal Khashoggi was just one of many influential voices that was targeted by this Saudi Arabian government-sponsored troll farm. What do you make of that, and how widespread are these state-sponsored troll farms?
That's right. We've actually found that the state-sponsored trolling sort of spreads all around the world. Governments from Turkey to Saudi Arabia, but also within South America and Southeast Asia are making use of state-sponsored trolling as a mechanism to silence dissent, to target journalists, basically to stop people reporting. And it's a real strike to democracy when basically Twitter and Facebook, which were heralded as platforms for free speech, are now being co-opted by governments for control.
And how would you contrast the strategies that these different nation states are using? Are they learning from each other?
Yeah, we've found that to some degree the nations are learning from one another. Oftentimes what will happen is 10,000 or 15,000 accounts on a site like Twitter will be used to simultaneously attack multiple journalists, to threaten them, to harass them. But also a lot of the time these accounts are also used to attack activists, to attack political opposition, and even to do transnational political attacks against news media and other organizations.
Now, Twitter's been releasing data that it's challenging millions of potentially spam or malicious accounts every week, and we know that it's one thing to identify clearly, machine-driven automated accounts, but what happens when you mix human interference with that? Can Twitter accurately find all of the manipulation?
It's a real challenge Twitter and other social media companies face to track automation and to track human-driven propaganda. Oftentimes the most sophisticated propaganda comes from cyborg accounts. They use automation to reach out to people to amplify the attacks, and then people add that element of sentiment of really targeted harassment. But that said, the companies Twitter has had since the mid-2000s to try to combat this problem, and it's existed well before 2016. It's a problem that should have been in hand a long time ago.
We know Twitter is shifting resources to this problem. Jack Dorsey has said his #1 priority is healthy conversation on the platform, and Facebook is hiring thousands upon thousands of content moderators. But what more should these companies be doing to actually address this problem?
Sure. There should be flagging of automated accounts. So any accounts that make use of automation, especially for political purposes, should be known to the user. There needs to be more curation of harmful accounts. They've got to keep deleting accounts, and they've got to look beyond the United States. It wasn't until 2016 that the companies really began paying attention to this problem. But this problem has existed around the world, especially in authoritarian countries, for a long time. So it's time for them to start doing some real cleaning of the house.
And how are the regimes evolving their tactics to deal with the new and changing stricter regulations for Twitter and Facebook involving automated accounts and manipulation?
Yeah, in my research and in my conversations with people who make and build this technology, bot-making technology, they often say that they're one step ahead of the social media companies, and I think this remains true. The bots that we see now being used to proliferate propaganda attacks or harassment are much more sophisticated than they used to be. One of the things that's happening is the advent and use of headless browsing bots, which don't log in through the API, through the back end of a site like Twitter. They actually log in through the homepage, and so the detection algorithm on a site like Twitter has a really hard time finding them, and so the companies really have a bit of a mess on their hands.
And Twitter finally released this comprehensive data set of accounts potentially linked to the Iranian and Russian government. I mean, what were your biggest takeaways from that gigantic data dump?
I think it's really good that the company is working to release this kind of information. I think that they need to continue this work. They need to focus internationally. They need to not just be releasing information on the Russians or the Iranians and their influence on American politics, but they need to be looking into the ways that this happened in countries like Myanmar and throughout the West and throughout the world, really.
Fascinating research. Director of the Digital Intelligence Lab, Institute for the Future, Dr. Samuel Woolley, thanks for joining. Amazon is teaming up with American Express to debut a no-fee card. The two companies unveiled a new co-branded card for small businesses. Cardholders with an Amazon Prime membership will be able to choose between an interest-free loan for 90 days or 5% back on purchases made at an Amazon subsidiary like Whole Foods. The card will also offer 2% back on purchases at U.S. restaurants and gas stations and on mobile phone services. Meanwhile, Amazon's cashierless convenience store is coming to the Big Apple. The e-commerce giant is planning to open up its latest Amazon Go store across from the World Trade Center. That's according to Recode. Amazon is said to be planning to open 3,000 such locations by 2021. Currently, there are 5 Go stores across the United States. And for the second quarter in a row, Amazon has set a company record on spending to influence U.S. policymakers. The world's largest online retailer spent $3.6 million on lobbying the federal government in the third quarter. The company is competing for a $10 billion cloud computing contract with the Pentagon. Coming up, Andrew Left making a U-turn on Tesla. Next, we ask the famed short seller why he's long on the stock. This is Bloomberg. Verizon reported better than expected subscriber growth, helping earnings beat estimates. Still, customer churn and the continued loss of TV viewers hurt results at the largest U.S. wireless carrier. Verizon is still in the early stages of rolling out a 5th-generation network that will thrust the company into the business of offering pay TV over wireless signals. Naspers is looking to food delivery in India. According to sources, Africa's largest company by market cap plans to boost its stake in Swiggy, an online Indian food delivery business. It's Swiggy's 3rd funding round of the year, and the company's already valued at $2 billion. Could also be the biggest round to date. Sources say Naspers could support a raise of as much as $600 million. Tesla may be one of the most shorted stocks in the U.S., but it's getting help from a most unlikely source, one of its outspoken short sellers. Shares gaining the most in 3 weeks as Andrew Left of Citron Research announces he's now long on the company this quarter. Earlier this year, Left sued Tesla and CEO Elon Musk for, quote, stock manipulation and predicted shares would slide to $100 by year end. Bloomberg Markets caught up with Citron Research founder Andrew Left and asked what's changed.
It's amazing. Elon Musk has made such a sideshow of himself that people started to forget about, including myself, the underlying business. And all the headlines are about Musk does this, Musk does that. And then you start reading about the car. So once I scrape that past, and as a short seller, I'm always rechecking my thesis. And up to a few weeks ago, I was short. And I'm rechecking, then I'm like, oh my God, this car is just dominating. And the Model S is still dominating. Not just dominating, they're just completely smoking the competition. And then I'm like, well, can they make money? So I started to read more and go more and deeper and deeper. And I realized that for all these years, I didn't really understand the Tesla stories. I'm understanding it more. Now, I'm not this uber Tesla bull, and I know there's still a lot of factors, and execution is still there.
Right.
But I think being short, going into this quarter, knowing that he just made earnings a week earlier, right on top of Ford's earnings, and knowing that the company's finally hitting stride with production of the Model 3, and I see the short interest, I'm like, oh no, that's just wrong.
Yeah, I'm looking at the short interest, and it is still elevated. So you think the October 24th new date for earnings is a positive sign. I want to know about where we go in terms of capital needs for Tesla, because there's a lot of worries that always they need to raise more money, might have to therefore add supply to the equity out there. You're not worried about that anymore?
I mean, we'll know in about, what, like 26 hours, 27 hours? See how much, if they generate free cash flow. Musk said, you know, for years I've doubted Musk. When I heard the word gigafactory, I laughed. There's so many different things that Tesla said they were going to do, and I laughed. So sure enough, I mean, I think the guy had the quickest settlement ever with the SEC. He actually got the SEC to work on a Saturday. So when he says there's going to be cash flow positive, possibly this quarter, I'm not going to doubt it. I'll wait and see it.
So here's the thing. We need to put Tesla in the context of the bigger automotive picture and demand as well. Auto sales as a whole has plateaued. They peaked in September 2017 at an annualized rate of 18.47 million. Would Tesla be subject to the same industry headwinds, cyclical headwinds as everyone else?
No, that's the amazing part about it. That's what really surprised me. Not only is Tesla eating from BMW, Mercedes, and Audi, but they're also eating from Toyota and Honda. People are actually paying more money to drive a Tesla. It's a revolution that I actually underestimated the way people are buying these cars. So the numbers that you're talking about, 100% true for other automakers, not for Tesla. It is what it is.
Where, therefore, does the price target go for you in terms of you've got out there you've run some models?
So this is where it gets tricky. Because the real question, and that I always said as a short seller, is at the end of the day, it's a car company. But we're basing those estimates on profits on old school manufacturing. So the more you read, the more you see that, you know, by not sourcing as many parts, by not having as many parts, doing away with the dealer networks and unions, where does this model take you? And you don't know. And, you know, Monroe and Associates out of Detroit, one of the leading auto industry experts, said they could do over 30% gross margins on the Model 3. I'm sure they'll do more of those on a crossover. So we don't know. And that's where it's become a black box. I'm not even looking at the shared mobility or solar city. Let's call all that call options. I put a sensitivity analysis in the story on just selling cars globally.
Now, I wanted to get to pot stocks as well. Oh, wait, just before then, sorry.
Yeah, Caroline. Quickly, one last question, Andrew, because you write in your note that you're still pursuing, to sue Elon Musk over the price target that they put out, 420, that tweet, you lost money, and the fact that they used overall by putting out that tweet that they would hit that sort of price point. What, therefore, are you still sticking by? Why are you still wanting to sue Elon?
Well, it's just business. On that particular day, I was short the stock. He said funding secured. Funding wasn't secured. I want my money back. That's it. That has nothing to do with my position on the stock today.
Right. It has nothing to do with your outlook on Tesla, the company, either at this point.
Nothing at all. If the stock goes to 800, 200, that lawsuit lives within itself. It's that one particular day.
All right. So self-contained. Let's move on to the self-contained world of marijuana stocks, or perhaps not. You were shorting Kronos and Tilray. Have you closed your shorts, or is there still more downside to come here?
There's still more downside to come. I mean, possibly, you know, if somebody wanted to buy, you know, if you wanted to put your foot in right here and buy some Canopy, that would be the leader in the space. But yeah, Tilray is just a low float story. I think Kronos is not going to deliver for REC for their investors. It's a longer story. And I was also short, you know, some other smaller names in Canada. It fell apart a lot faster than I thought. I mean, I knew it was a sell the news event. I didn't know it was within 3 or 4 days.
And Andrew, I mean, interestingly, though, we still see companies coming over to the US to get some more investor base. We've just seen Aurora list on the New York Stock Exchange as well as over in Canada. Could the added volume, the more stocks to be able to get involved in, also drain out the appetite from the market?
I mean, there's a difference between added volume and hysteria. So what we saw over the past few months, which is pure hysteria, it was completely removed from all fundamentals. And, maybe it'll come in more, and it would be great if these stocks do become investable. Let's let them put out a few quarters. You don't have to be such a rush. If you believe they are long-standing businesses that are building, real businesses that will stand the test of time, you could buy it next quarter or the quarter after. Let's see how they do.
That was Andrew Left of Citron Research. Netflix found itself in an unusual situation during its latest debt sale. The world's largest paid online TV service had to offer yields at the high end of price expectations. That's the first time that's happened. Netflix priced $800 million of bonds at a yield of 6.4% today, and another $1.2 billion for 4.6%. The company now has more than $10 billion in debt. Meantime, Amazon's scattershot attempt to shake up women's fashion isn't going so well, at least according to a report by data research firm Jungle Scout. Apparel makes up 88% of all Amazon private label brands, but only 1% of all private label sales, according to the report. Women's fashion, which makes up most of the company's clothing brands, is struggling the most. And that does it for this edition of Bloomberg Technology. Make sure to tune into tomorrow's show. We'll be covering all things Tesla as the earnings come out after the bell. This is Bloomberg.